Have you been following the news lately? Leading investors are asking tough questions about America's future. In this video, I'll explain why they're worried and what it means for you. Hey there, this is Simply Economics. If you want to be in the know of what's new and what's hot, click that subscribe button now. Recently, there's been a lot of talk about the USA's economic situation and how it may be faltering despite all the hype from Wall Street and the media. And this isn't just speculation. Leading investors are doubting the US now more than ever. Let's get started. The United States of America has long been viewed as the land of opportunity and a safe haven for investors. However, in recent years, there has been a growing trend among top investors to bet against the USA. This shift in sentiment has raised questions about the stability and future prospects of the US economy, the current state of the US economy. The U.S. economy has experienced significant challenges in recent years, including the 2008 financial crisis and, more recently, the COVID-19 pandemic. These events have caused disruptions in the stock market and overall economic growth. In addition, there are concerns about income inequality and high levels of debt among both individuals and corporations. Despite these challenges, the U.S. economy remains one of the strongest and most resilient in the world. With a GDP of over $25 trillion, the U.S. economy is still the largest in the world, accounting for nearly 25% of global GDP. Why the sudden shift? Some point to the growing political polarization and instability in the country, with recent events such as the storming of the Capitol building highlighting deep divisions within American society. Others cite concerns about rising inflation and the potential for a market correction after years of steady growth. There are also fears that the U.S. dollar may lose its status as the global reserve currency, potentially leading to economic turmoil. Top investors are expressing skepticism about the state of the U.S. economy. Prominent investors are placing their bets against the U.S. economy, underscoring the intricate link between the stock market and the economy. This connection has the potential to unleash a ripple effect, leading to adverse repercussions such as financial and job losses. The stock market and the economy are interrelated, with one's performance affecting the other. The global economy has a significant impact on companies worldwide. The claim that the two are separate and weakly correlated is puzzling, as influential investors rely on economic predictions. This raises doubts about the validity of such claims. Increasing the money supply results in inflation. Economists hold sway over interest rates and the creation of money, while also exploring the profitable correlation between the S&P 500 and U.S. GDP. Expanding the money supply inevitably leads to inflation, prompting econometricians to meticulously collect data on diverse economic factors for the purpose of quantifying this relationship, aiding decision-makers. Although economists cannot predict the future, their ability to shape interest rates and money creation remains influential. Moreover, the easily discernible correlation between the S&P 500 and the GDP of the USA holds immense potential for profitability. Correlation between economic performance and stock market growth can vary. As demonstrated by the example of the USA during the global pandemic, it is important to highlight the complex and opposing forces that can influence the relationship between GDP and the stock market. While there is no strong correlation between these two factors in the short and medium term, it is worth noting that they can still have interconnected effects on the overall economy. High consumer debt can offer short-term benefits, but it can hinder long-term economic growth. Japan's stagnant economy is partly due to high consumer debt, while the USA's balanced approach to debt management and policies has resulted in strong growth. The relationship between GDP, the stock market, and consumer debt shapes economic landscapes globally. U.S. is becoming less appealing to foreign investors. Foreign investors may find the USA less attractive due to a smaller number of large companies, limiting investment opportunities. However, the immense size of the U.S. stock market offers a vast platform for capital allocation. Yet, its sheer size and complexity can present challenges in terms of volatility and risks. When investors bet against the economy, they employ different strategies. Some speculate on the stock market through short selling or inverse ETFs, while others turn to safer assets like government bonds. These diverse approaches highlight the complexity and adaptability of the investment landscape, where investors navigate ever-changing market conditions. Does the confidence in the U.S. economy still prevail? Despite growing skepticism and concerns about the future of the U.S. economy, many still have confidence in its long-term stability and growth potential. The country has a strong track record of overcoming challenges and adapting to changing economic landscapes. In addition, the U.S. government continues to implement policies aimed at stimulating economic growth and addressing issues such as income inequality. This shows a commitment to maintaining a healthy and competitive economy. Overall, while there may be uncertainties and challenges ahead, the U.S. economy remains a major player in the global market and continues to attract investors from around the world. Thanks for watching, guys. If you enjoyed this video, please make sure to give it a thumbs up and hit that subscribe button so you don't miss out on any of our future content. We truly appreciate your support. See you in the next one.